Well, good morning to the West Coast and Central U.S. and good afternoon to everyone else. My name is Brad Etheridge. We're happy to have you with us here today in one of our webinars that's leading up to our Academy. A little bit later in the program, we'll give you a little bit of detail on what the Academy is. And Joe, our primary speaker today, is going to be one of the folks covering some incredible information. Tell you a little bit about the Center for Tax Strategies and Resources. We are not an IMO. We're not a broker-dealer. We're an organization that's all about training, education, and community for professional financial advisors, planners, CPAs, tax attorneys, PNC agents, anybody in the business that has to deal with high net worth individuals, business owners, or the general public. How to become, what we do is we train, mentor, collaborate, help you create better marketing for your practice. And we build teams using our resources to make you larger than you would be by yourself, because we know most of our folks are independent, but now you can be independent without being alone. This group has incredible resources that we make available to our members. And just so you know, the membership itself is based on membership dues. We'll talk a little bit about that later on. And we'll talk about what the other advantages are of being a member, other than being able to meet super cool people that are very smart, like our speaker, Joe Strazzeri, today. Let me tell you just a little bit about Simon Singer, who is the founder of the Center for Tax Strategies and Resources. He's been successful in our business since 1966. He founded the organization primarily because there was a huge lack of availability for training. You know, back in the olden days, you had captive agencies and home office trainers, and all that stuff's gone. Simon said it's a shame to take the 50+ successful years he's had as a producer and have that stuff wasted. It's really hard to find it. So he had the vision to start the Center for Tax Strategies and Resources. And you're going to see a little bit today of the caliber of folks that are involved in our organization and why we could help add a few $100,000 a year to your practice income. Simon has written several business bestsellers. He's members of very prestigious groups such as Advisors in Philanthropy, and is the past president of the International Forum, and is the National Humanitarian Award recipient. And I could go on and on and on, but we want to get to Joe, and I want to give it back over to Simon. So take it away, Stuff. Take it away, Stuff.
Actually, you could go on and on and on. I kind of like listening.
I'll call you later and tell you how awesome you are. How's that?
We are all too old to be able to go on and on and on.
That's true. In any event, Brad's explanation of the reason why, our industry does not have the world's greatest reputation, and a lot of that is because of complete and total lack of training, not only in product, which is what the industry has become all about, and numbers on a page, but how to deal with professional advisors, how to create relationships with professional advisors. We will have 4 tax attorneys at the Academy speaking because of the fact that we've been able to create relationships with people like that. And this may come as a strange aware to you, but they need the next case also, just like we do. But you got to know how to have the conversation. You got to know how to set the stage, and you'll find it very intriguing. In any event, Joe Strazzeri, our speaker today, is was trained as a general contractor. He hammered nails all the way through law school. So he has a unique perspective that most tax attorneys don't have, which is that of a business person. And he has a number of training entities, one of them helping people understand how to help people set up their business for sale, whether it be an internal or an external sale. One of them to help train professional advisors, tax attorneys, CPAs, and occasionally people like us as to how the other side thinks and how to put things together that is both legal, moral, and ethical, but financially works for all people concerned as well. So you'll find Joe very unusual in that he's got a personality which a lot of CPAs and tax attorneys don't have. I've known Joe now and have worked with him for about 15 years. I think you're going to enjoy this, and I think you're going to walk away with some ideas that you can put into effect tomorrow. In any event, at this time, my friend, tax attorney extraordinaire, Joe Strazzeri. Joe?
Thanks, Brad. Thanks, Simon. So can you see my screen yet, or do I need to do something to make that happen?
We can see you. Actually, we can see your screen. It says Southern California SC Institute.
Okay, so how do I make this go away?
Just click on the main screen.
Where is that at?
You do what I do, Joe. You call Todd.
Well, I call Taz because Taz makes all that come together.
Exactly.
very much, Daz. Thanks, guys. So that all being said, first, thank you very much for having me. We have about 45 minutes. Would that be right, Todd?
Be right. And then some questions if you'll sit around
Sure.
with us.
Joe, probably about halfway through too. I'll kind of jump in because I know you can't see our faces on the screen when you're presenting, but we're going to talk a little bit about the Academy for a couple minutes, somewhere in the middle. Okay.
Sure. Just tell me. Now, mind you gave an Italian attorney a microphone and a stage, and you're going to slow him down. I love that thought.
Gonna try.
Sure. Within this, I'm going to take 2 minutes first. Every time, and you guys, people who have done this regularly have heard me say this, every time you listen to a presenter, remember to understand what their bias is. How do they get paid? Where do they come from? What is their bias? How are they seeing the world? So my bias, my partner Steve and I, with other partners that we have running them, own 5 organizations. This is 3 of them. The Southern California Institute, very similar to the center that you belong to, started for very similar reasons. We put on over 250 programs a year, 2/3 to advisors, 1/3 to clients on legal, financial, tax, and counseling. Strazzeri Mancini, the law firm, my name is Joe Strazzeri. We're a mid-sized firm of now 7 attorneys as of yesterday, where we help successful families and business owners do 2 things: get to the heart of highly relevant matters, so counseling, and resolve messes. And that is the second largest way we get business, by saying we can help resolve the mess. In the areas of integrated tax and estate planning, what we're talking about today, business succession, and then family governance counseling or family business conflict counseling, the largest way we help advisors acquire large families or successful families and business owners, because wealthy families often have dysfunction within their business or themselves. Lastly, Founders Group. We help business owners with, do I keep and grow my business, or do I transition it to my family, to my employees, or to a third party in whole or in part, now or later? So that gives you a bias of the way we think and what kind of things we do. We're going to talk about the 10 ways out of highly appreciated property. We'll talk about their typical plan, the 10 exits, and then helping clients understand and choose. First and foremost, this presentation by no means in 40 minutes could give every technical bit of every one of these. The goal of the presentation is to be able to give you language and tools to speak to other collaborative advisors and speak to prospects and speak to current clients and speak to past clients to say, you're considering selling or not based on a 1031 exchange, or selling or not based on a CRT ILEC combination. Have you considered all 10 ways out? So it causes the client to say, I'm sorry, say that again, to start the conversation, to restart the conversation. So the goal of the presentation today is to widen your perspective, give you language and tools to help acquire those clients or serve them well. So the typical plan. Clients that you will have that have property, that have had it for a long time, have a swap till you drop attitude. They've been using code section 1031. Really old dogs will call them Starker exchanges, because Mrs. Starker is the one that caused this with the IRS, that the IRS then codified in 1031, where you can take a piece of property, sell it, give the money to an accommodator, and as long as you point and find properties within 45 days and close within 180, you don't pay capital gains tax. So I have a piece of property that sold last week. I bought the dirt for $100,000. I built it for $5. It's got about $600,000 into it. Over 30 years, I've depreciated the $500,000 of the building. My basis is $100,000. It sold for $2.8. I've got a $2.7 capital gain. That means I've got $850,000 tax that I'd have to pay. If I take that property and I sell it and I stick the money with an accommodator, what's called a qualified intermediary, looks and smells and tastes like an escrow company, and they get it, and then I take that and I find, in the typical rule, either 90% of a bunch of properties, or I choose 3 properties that I will identify to do it within 45 days, and I close on that transaction within 180. I have to put that much money or more with at least the amount of debt. I have no debt, so I don't have to worry about that. It goes then, I don't, buys a new property, I pay no capital gains tax. Your clients know these rules down pat and have done it multiple times as they bought and sold and exchanged up the chain to get bigger properties. They know this stuff. You've got to deal with appreciation recapture I just talked about. And always be careful inside of B trusts and limited partnerships, because we do this swapping, because if I own a separate property, the day I die, the property gets a step up in basis. So if my heirs sell it, there's zero capital gains tax. If I own a community property in a community property state, or community property in Alaska, if I live in a non-community property state, and one of us dies, my wife or I die, it gets a complete step of basis to where she can start to redepreciate, or she can sell it without having a capital gains tax, just like my heirs would. So community property rules help a lot. Notice how I killed myself off first. The 10 exits. So let's talk about 10 ways to do that that isn't a 1031. So we say getting off the 1031 exchange train without having to die. Client says, wait a minute, what do you mean? There's a way to do that? So we're going to cover each one of these 10 one at a time. I'll give you this list again at the end. So tenants in common.
Hey,
Let's
Joe,
give you a little bit. Yes, sir.
can I interrupt for a second?
Of course, you can do anything you want. It's
Yeah,
it's your center. I'm a mere loving guest.
I understand. So part of the problem with the 1031 exchange and the time frames of 180 days and 45 days is sometimes people are forced to get involved with properties that they may not otherwise get involved in. Isn't that so?
Very much so. So I'm under a gun right now. It closed last week. I'm 9 days into my, 9 days into my 45 of identifying. So there's pressure on me right now. All sorts of people want me to buy DSTs and a tenant in common and wind up this property. And in California, ADUs are very popular to get into these days. But I'm thinking to myself, well, hell, I lost 6% of my investment in the commission. I've got now 94% to invest. I'm going to put it somewhere. Where is it going to earn the most? Am I worried about losing the 1031 one day because of Joe Biden and crew, which is what they've got their eyes on? The pressure of this is pretty high. And older couples get really nervous about how do I find the thing, because they were happy to sell at a high market, but they don't want to pay a high market. So you're right, there's a lot of pressure, son.
Thank you, Joe.
Oh, by all means. So a tenant in common. This is a historic way to do this. It's still a 1031 exchange, but instead of my selling my property, going to an accommodator and buying a singular property or a couple of them, I'm going to go buy a piece of property with Simon. We're going to own it together as tenants in common. So that tenants in common is a historic way. Two people could own property that if one person dies, their estate gets it, as opposed to joint tenancy, two people have it, one person dies, it goes to the other. So within that, I'm going to be able to use the 1031 exchange rules. There was a company in Santa Barbara that were putting together tenants in common with multiple people buying into a piece of property. And the FINRA and the SEC looked over and they said, that looks and smells and tastes like a security. There was an assistant, a secretary in the office that was securities licensed, and they said, you have to be securities licensed to do this. The industry just said, you mean you can sell real estate, buy something that I can get a commission on, and it qualifies for 1031, we're in. And hence the TIC world, or tenant in common, TIC world, was born. It was the wild, wild west in the beginning, people charging 2 to 5% to run it per year, charging 6% up front, charging exiting fees. And it turned out to be not such a great investment most of the time until the government got involved, white papers came out, and what ended up happening was it became a very regulated industry. Now it has securities returns like anywhere else, and you can do triple net properties through TICs, et cetera. Very common. Most people in the financial industry know this. Delaware statutory trusts are a variation of tenants in common, which we'll talk about in a little bit. Rental to residence to sale. Most of clients that have real estate portfolios have their historic home that they moved out of that they now rent as part of it. If they sell that rental, they depreciated the depth out of it, and it's going to cause a capital gain. So they said, well, I understand you can have two personal residences. What if I stop renting it and maybe let my daughter Taz live in it? And if she does, it'll be considered my second home. And I can then use this rule about $250,000 per person or $500,000 per couple to sell. I'd have to live in it 2 of the last 5 years or have a pro rata amount of that. So I could avoid $500,000 of capital gain. Now, you either need to move into it, or you definitely need to stop renting it, not even your family, or call it a second home. And if you lived in it for, let's say, 4/5 of the amount of time, as a couple, you get $400,000 of the exclusion. It's 2 of the last 5 years. So I could have lived in it for 2 years, starting 5 years ago and still qualify, or 2 years ending now. And if I want to pro rata about it, I could. So for people that are worried about a $500,000 or less gain, great way to do it. Absent losing the income, which often they lose a family member in anyways. Next, charitable remainder trust. Simon, how historic are CRTs?
If I remember correctly, Joe, I think they go back for more than 60 years, don't they?
Yep. And what is the instrument often included with the CRT?
Well, that depends if it was presented by a tax attorney or a CPA or a financial planner / insurance agent, because the way to replace the property would be a properly structured life insurance policy and an irrevocable trust.
So I agree with Simon. You'll get CPAs and attorneys that will present this and will forget to replace the asset for the kids. So I take my property, I put it inside of a charitable remainder trust, which I'm allowed to be the trustee of and still in charge of. The trust is an irrevocable trust. That trust says I'm going to get an income, either a stated amount or a percentage of the trust each year for the rest of my life and my wife's life. My own life, if I was single, the 2 of our lives, if we're, or joint life expectancy, if we're married. At the end of that time, that asset is going to go to a charity of our choice. And it could be something that's guided by our kids, et cetera, or a public charity, or a DAF. But let's think about something. If I put my asset in there, let's say my $2.8 million property with a $2.7 million gain that I have to pay an $850,000 tax for, it would only give me 1.95 at the end. Could I instead put it in this trust the next day, or the next day, a time later that I didn't have a buyer yet, a time later, sell it, it pays no capital gains tax, and then there's $2.8 million in here that's generating income for me. Now, Simon, what earns more, $1.95 million or $2.8 million?
I'm glad you asked me that, Joe. Not many people think to ask that, but I'm betting that it's the larger number.
Or it depends on who your advisor is. But at the end of that day, I have $850,000 more to invest. If I'm investing that and I'm getting a 6% return, I'm getting some 50 grand a year more than I would have. Oddly enough, if I dedicate half of that to insurance and half of that to going on more cruises, everybody wins except for the IRS. I get a greater income. I get to diversify this real estate asset for a diversified portfolio that my financial advisor can manage. My charity is going to get money when I die. My kids are going to get an asset that they want, which is cash, more than the property anyways. We're all good. This has been around forever. In a low interest rate, CRTs friggin' rock because of the way this can cook. As I take out this percentage over time and my portfolio does better than that, I'm going to take out even larger amounts of money towards the back end of my life. I can even structure it to where it pays out more later. Now, in here for a financial advisor, we're now taking a real estate asset that is not managed at all. We're converting the whole thing into AUM, and they're buying a big life insurance policy, and they'd like to work with the rest of you, and they're going to tell your friends, their friends that think 1031 is the only way out, that you're a help. Very traditional way to play it. Partial transfers. Could I gift part of this to my kids and keep up the rest in order to get a step up in some of it, but give my kids some early? Yes. And that's going to be important here in a minute because there's some interesting ways to do that. One of them is a gift up to step up. My mom is in her 80s. Let's say that she has a small estate, or that Biden doesn't reduce it down to 3.5 and we kept it 11.7. So small estate or that. Could I, as G2, gift to my mother my $2.8 million property? I've used up my gift, my amount that I can use by the time I die, but I can gift it there. She can then put it in a trust that will be included in the estate when she dies. But when it comes to me, it'll have a full step-up basis. I can start to redepreciate it, and it's creditor protected, and it will never pay an estate tax again because it's in a dynasty trust. So I get use of it, I get it creditor protected, and when I die, it goes to my kids, they get the same thing, and it never pays an estate tax because it qualified for GST. Wow, isn't that cool? Now, it's sad to think about my mom dying or somebody's parents dying, but unfortunately, it's going to happen. If I sat down and talked to my mom, she'd either say, oh my gosh, Joe, let's not talk about my dying, or she would say, any way that we can stop giving the money to the government, Joe, we should do. So gift up to step up is a great answer. Private annuity trusts. You cannot do these anymore, but what we're going to talk about in a minute is an extension of the old private annuity trust rules. So for a little bit of history, a private annuity trust was, I have my property, I sell it to Simon in a trust. Simon's my brother. So we're keeping it in the family. I sell it to this trust that Simon runs for an installment note. I do not pay capital gains taxes unless as I receive the installment payments. So let's say I get $1,000 a year. Out of that $1,000 a year, $30 or $30 is return on principal, $970 is capital gains, and I pay capital gains on $970. Not the $850,000, but $300. Simon then later this year sells it to a new buyer for $2.8 million. Simon's basis in that trust was 2.8, sold it for 2.8, no capital gains tax. The IRS in October of 2006 said, for 2 years I've been telling you to stop it, really stop it, because it's a step transaction, because of what are known as the related party rules. So if you have one of these that you see, a private annuity trust, dated before October 2006, don't mess with it. If it's dated after October 2006, there were still promoters doing it, get them to a tax attorney or accountant to tell them how to unwind before they get in trouble. That's important because of the deferred sales trust rules. The deferred sales trust is a trademark term by the estate planning team, a company owned by Robert Binkley. There's been a great amount of marketing for this because they say, sell it, put it in a trust, buy securities. As you draw the money down, pay capital gains, but more money is making more money. So you have more money to manage, more income for later. And wink, wink, if you need principal, ask us. The wink, wink bothers everybody. There should be a third-party arm's length transaction. They're pretty good at what they do. The drawback is that the estate planning team keeps half of the money management, and if there's any profit at the end. In an intermediate installment sale, there are many trust companies entering this world. that will allow the financial advisor to manage the whole asset. To manage the whole asset. So within that, then, we want to make sure that it's a intermediate installment sale. If we're going to monetize it later, we have to worry about a $5 million rule. So if 2 years later, after the related party rules problems go away, if somebody wants to borrow money on the installment sale, they probably could. They can't originally because if you're not allowed to sell something for an installment and then take a loan against the installment, it's treated as all income. But after 2 years, probably not. So deferred sales trust, great answer. More common term for it for the IRS, intermediate installment sale. It solves for the same thing we talked about before, but instead of me selling it through a trust controlled by my brother, it's sold to a third party trust, not controlled by me at all. So you're allowed to do this. You're allowed to do this. So deferred sales trust marketed is an intermediate installment sale.
Hey, Joe, I know what this is.
Intermediate installment sale. I'm
I
sorry.
know what this is. Can you kind of talk briefly about the $5 million rule?
Sure. When you monetize, if you were going to borrow against the installment note after 2 years, and we'll talk next about doing it sooner, you're only allowed to delay the tax for 30 years. At the end of the 30 years, with this installment, the tax comes due at the earlier of when you receive it or a 30-year time frame. So most of these run for 10 or 20 years, but if you monetize it, you might want to last 30 years, and the capital gains tax is then due at the end of the 30 years, and you're only allowed to do $5 million per person. Did I say that well, Simon?
Oh, that was good. Perfect. In fact, Joe, I'll give you a chance right now. Maybe we'll cut in here a second, give you a chance to get a sip of water and talk a little bit about the Academy coming up for a moment. This seemed like a pretty good place to let everybody know about our upcoming Academy event, which is going to be virtual. So no TSA lines and having to pack bags and iron your shirts. So this will be, you can do this right from the comfort of your home office or any electronic equipment. You can broadcast and you can watch this technically from the golf course. But we have an Academy coming up here. I want to tell you a little bit about what is going to happen over those 3 days. We have our faculty, which are our experts, that our members all have access to as part of being part of the group. But we're going to bring in these experts over this 3-day period, and they're going to cover some amazing topics that can just be incredible. If you're not watching this at the event and have a notepad where you end up with 10 names of clients that you could apply that to, I'd be shocked because nobody ever does less than that. Just a great way to really enhance the tail end of your year here and get you ready for year end. It should be one of your best times of the year. So this Academy starts at 8 o'clock in the morning Pacific and ends at 3. We do about a 20-minute break for lunch in between for returning phone calls. If you get into the virtual Academy, the guests, the folks, those of you that aren't members, will have a week to be able to review the material. It'll be recorded, so you can go back and play over any of those parts as many times as you want. For the members of our group, by registering for the Academy, you have unlimited access to the recordings in perpetuity. Now, our members pay less than the general public. You can find the registration for this. In fact, we'll send you a link as soon as this is over also, but you can find our registration at www.yourctsr, your Center for Tax Strategies and Resources.com, and click on the upcoming events tab. Again, members, make sure you're going to the member portal and then register from there. If you need more information on what we've talked about today, or you just need some more information on why you want to become a member of our group, you can call 877-258-2837, or you can email the center team at yourctsr, and we will put this up again at the end of the program. And with that, Joe, you've had more than enough time to get a sip of water, so I will give it back to you, sir.
Why, thank you. So thanks a lot, Brad. I'll say that it's a privilege to teach with great people like this. I'm looking forward to where we can be live all together again. And by the meantime, this is great. Even I've got 7 lawyers. Having a mentorship amongst ourselves for that is important, but also amongst our friends. I often tell my attorneys, it's more important for them to go to programming taught by the other professions than taught by lawyers. Keeping our ecosystem is bad. So hearing from the other collaborative advisors that you may work with in your community, at least their types, is good. And hearing the other subject matters, especially if you're in the financial services industry, where you are the quarterback for the client. They're your client, where you're bringing in other experts to help, whatever firm you're at. So that being said, oops. So I mentioned deferred sales trust. Let's talk about a twist. A monetized installment sale. It is first and foremost an intermediate installment sale, just like we talked about. But second, sometime afterwards, probably 45 days or later, because it shouldn't really come all together. Sometime later, so it isn't a plan, there's a monetization or a loan. So how do you qualify to take, because you heard me earlier, you cannot take an installment note and take a loan against it without it being called income. So how do you how can you not have that problem? You could wait the 2+ years. That's great. If you wanted to do it sooner, it would be through a third party, and that costs about 6.5%. So if I took let's do my math quickly, my $2.8 million property, and well, that would put $2.8 million property, and I multiplied it by 93.5%, I'm going to end up getting, well, let's go back, sorry about that, multiplied by 0.935, I'm going to get $2.6 million to play with right away. It cost me 6.5. Remember that $5 million rule, in the 30 years from now, I'm going to owe the money. So if that's true, I probably also have to put a 6% side fund that grew over time that covered the tax. So instead of a 33% tax fed in the state of California, I'm going to have a 12% loss on this. I'm going to be able to pay with 88% of my money. So there is a strategy called a monetized installment sale, which is an intermediate installment sale, then a monetization of the note that falls within the rules. It is more aggressive. The IRS is looking at it more harshly. If you have a client who's been doing conservation easements inside of their tax returns, and they're probably going to get audited, offering this up on top of it, silliness. If you have a client where this is a small part of their portfolio, they're willing to take the audit risk, the rest of their books and tax returns look great, and they do this not in the same day, but with a 30 or 45-day spread, and it doesn't look like a step transaction, lose a quality organization, probably okay. So again, it's a matter of risk reward or risk tolerance for a client. Next, equity stripping. This is the old generational split dollar. For those of you who've been around the business in life insurance for a while, generational split dollar is no new news to you. But it's really important in today's market, because I have people that are worried about their capital gains tax if they sold the property, but they're trying to do some planning with their family. So can I borrow against the property or strip the equity and lend it to my kids? The rule about lending to the next generation is repayment has to be in the life expectancy of the mother that's lending it, which is a short amount of time, with the sole exception on if I, as a child, buy life insurance. If I buy life insurance with it, that loan can be repaid back when I die. So then that loan that has all that time with that little interest has very little value when my mom dies. It gets a major discount, somewhere 35–40% by the time you're done, because of my long life expectancy. So what we can do then is I can get assets into my estate to get insurance on my life, to do my estate planning, whether, let's say my sister and I both did it. Mine would be estate tax reasons, and it would be because I want to get money to my kids. My sister, who has less assets, would be an asset accumulation vehicle that she could borrow out of over time. So a great way to use the generous split dollar rules by stripping equity out of the property to do this, letting there be a step up when mom dies, when that mother dies, but still doing great things to reduce that estate tax and getting great financial planning in our lives. For me, dealing with my future estate tax. For my sister, dealing with cash accumulation that she could borrow against, which she didn't have before, to soften her life up. So next, opportunity zones. There's going to be a couple of slides because some of you, this is old hat, some of this is brand new. First and foremost, never tell a client you can sell a property and you don't have to go through an accommodator. You just have to reinvest it 180 days and there's no capital gains. That's not true. There's no capital gains tax today, but there will be by 2026. So you can sell the property, business tax, whatever the asset is, take the gain and reinvest it, take the basis and put it in your pocket. The only thing we have where you can put the basis in your pocket. So if you have a high basis asset, put that basis in your pocket and only have to reinvest the gain within 180 days. To a business or real estate qualified as an opportunity zone. You divert the tax to whenever you sell the new investment or December 31st of 26, which is payable in April of 27. If you hold on to the asset for 5 years, it's at 10%, 7 years it's 5, so now everybody's at the 5-year rule now. You generate or receive income on what you would have paid the tax on during the time till 26, and you've delayed the tax and you're going to pay less. So by doing so, you've got more money to pay it with, so you've reduced the capital gains tax by postponing it, not eliminating it. One of the nice things though is on the new asset you buy, if you hold on to it for 10 years or more, whatever it grows to will never pay a capital gains tax again. So if you hold on to it for 10 years or 20 years and you sold it, the future capital gain inside of it has no tax. We did this as a country to cause us to invest in areas that needed investment. But please don't think it's only blighted areas. There are areas here in Southern California, 7 miles from the beach you can buy. So there are a variety of good areas to still get into. But one of the drawbacks is if you do that, you are going to need, if I bought a new piece of property, whatever the building value, not the dirt, building value is, I have to add half as much in cash. So if I want to increase the value of property, that's great. I can buy into a fund. I can buy into a fund like Blackstone, where my financial advisor gets a commission, and the fund is going to borrow the money to add to the property. So I can borrow in a fund. Why is this great for a financial advisor? Because we're taking a piece of real estate, transferring it into an assets under management asset, allowing diversification without the hassle for the client. Client gets probably a greater return than they had because they weren't taking care of the property. Advisor gets to manage it. Life gets good. No capital gains tax later on. So we've talked about, in brief order, 10 exit options other than just waiting for a step up in basis, which is what we call swap till you drop, or your clients do. The intent of the program was to give you language and tools to talk to current clients, past clients, or potential clients, or advisors to say, have you looked at all 10 options? Because they're going to know about one. So you're going to say, yes, other than the 1031, what have you looked at? And they're going to say a CRT or whatever else. You're going to say, have you looked at the 10? And that's going to get them interested. And you're going to be able to talk about lots of other things. And in many of these strategies, you're taking rental income, you're taking a rental income asset, liquidating it, and turning it into an assets under management asset. And in some cases, on top of that, insurance to offer something too, because that's truthfully a complete financial plan for the asset. This is a financial planning conversation. This is not a tax. This is not a legal. Those are subcategories. This is a financial planning conversation. So with that then, helping clients understand, remember, are you giving advice? advice is you come to me and in 10 minutes I know what to do. How does my son invest his $20,000 that he saved? You can give that advice this quick. Should I start a Roth IRA or not? That quick. Engagement. The client sends you stuff, talks to you, sends you everything. You go away, you think about it. They come back, you explain it to them. Or partnering. They send you the stuff, you look through the stuff, you have a long meeting, you go away and think about it, and you present options. A Goldilocks close. Too hard, too soft, just right. The 10 ways out suggests multiple ways to look at it rather than buy my one thing or not. Remember, are you doing advice, engagement, or partnering? If you spend the time on partnering, make sure your compensation matches. If you spend the partnering time on advice compensation, you're going to kill yourself in your life. So remember, what kind of time are you spending for the possible reward, and identify to the client what that is. The complication and significance probably requires partnering at this level, which means talk to them, they send you stuff, you research, you come back to them, you describe options, you choose together. It isn't buy my thing or not, it's which of these things should we do together. It causes stronger engagements and it creates great centers of influence, because if you include the advisor on the client, they're going to say, will you look at Sue and Mary, my other two clients, please? So it's about helping them understand and choose to work with you.
All right, well, listen, it was a pleasure being able to spend some time with you here today. I think you can see how with the right tools and talent and some folks behind you, you can be independent without being alone. Increasing your life insurance sales and tax savings is one of about 40 strategies that we try to put in front of our members on a regular basis to increase their practice revenue. And hey, after all, that's the primary reason why someone joins our group. Now, to get a really kind of in-depth explanation of some of these strategies and concepts, even if you never become a member, the Academy can help you increase your practice revenue. So join us 8 a.m. to 3 p.m. Pacific. And our end time is approximate. Sometimes we run a few minutes long based on what questions you ask, and we will be having opportunities to ask specific questions about your clients as we go through the program. To register, go to our website, www.yourctsr.com, and there is an upcoming events tab. Just click on that. Again, a reminder, members, make sure you're doing it through the member portal and log in as a member first. More information on the center, give us a call at 877-258-2837, or you can email us if you prefer at thecenterteam@yourctsr.com. Look forward to seeing you at the Virtual Academy. It is an unbelievable 3-day program that will change the way you think about helping your clients and moving your practice to the next level. So wonderful to spend some time with you here today. Hope everybody stays happy and healthy, and we'll see you at the Academy.